Okay, guys, let us go ahead and take on another example. On corporate valuation that is important from your examination standpoint. Now, let us go through this example in which you have been asked to calculate something called the price to book valuation. So let's go ahead and take on the question, the data. Yes.
ABC Limited had earnings per share of rupees 11.04 in 2010
Okay.
and paid out a dividend of rupees 6 per share.
So the company's earnings are rupees 11.04 and the company pays how much dividends?
6
rupees. Next.
The growth rate in earnings and dividend in the long term is expected to be 6%.
So that is supposed to be the expected growth in earnings and dividends, which is supposed to be the G, right?
Yes.
Which is 6%, that is 0.06 in decimal format. Next.
The return on equity at ABC Limited is expected to be 14%.
Now, you should all know that the return on equity is nothing but the earnings available to the shareholders divided by the equity funds, right?
Yes.
Or you can say earnings per share by book value per share. It's all the same. Return on equity given as 14%. Next.
The beta for ABC Limited is 0.8.
Okay.
And the risk-free rate is 6%.
RF is given as 6%. Then
and market risk premium is 4%.
the MRP, market risk premium, nothing but your RM minus RF, which is given as 4%. Next.
Now, based on the information, find out the price to book value ratio of ABC Limited.
This can be an MCQ question for 2 marks, where you have been asked to calculate the price to book value ratio, right?
Yes.
So I should have said MC question, because Q stands for anywhere. Question.
PAN number.
Exactly. Now let us go ahead and take on this example. Now first, let us calculate something called the dividend payout ratio, right?
Yes, sir.
Now what is the dividend paid by the company? 6
rupees.
And the company's earnings are 11.04 rupees. Now what is 6 rupees upon 11.04 rupees into 100?
So it's a 54.35%.
Or in decimal, 0.5435. Okay, that's no, you don't try the exam, but you can use a calculator. Okay, don't ever take any risk. Okay, so over here, please remember it is going to be 54.35%. Is supposed to be what? Is the
current dividend payout ratio.
Okay, got it?
Yes.
Very simple. And now, tell me, if I apply 54.35% on 11.04, I'll get what? I'll get the dividend per share. Yes or no?
Yes, sir.
If I apply 54.35% on 11.04 rupees, if I do earnings per share into what? Dividend payout ratio, I will get what? Dividend
amount
per
of
share.
dividend.
Understood?
Yes.
Not a big deal, no brainer. Now let us go ahead, jot down other information. Next, you can write down what? The return on equity and then RF, all those are given, fine. Given the growth rate is how much? 6%.
6%.
Now we shall focus on how to calculate the cost of equity. Now just see the formula, you all know this formula, okay? So the CAPM equation, cost of equity equals, it is RF plus, I'll take the beta of that share, that into RM minus RF, which is given, the market risk premium. Now what is RF? 6%. 6%. It's a coincidence, guys.
Yes, sir.
Growth rate 6%. Even RF is 6%. Okay, this is RF. I take 6% plus I take 0.8 beta. That into RM minus RF is what? 4.
4% given.
So 0.8 to 4, 0.8 into 4, okay, which is 3.2, then plus 6, 9.2%. 2% is a cost of
equity.
Okay. Now, how to find the price to book value ratio? There is a formula available out there. I want people to first jot down this formula. Just trust me, okay? Jot down this formula. I will explain this later. First, you got to write down this formula in your notebook. What is the formula? Price to book value ratio equals, it is return on equity, right?
Yes, sir. Into
That into what? That into the dividend payout ratio divided by the denominator. You take the cost of equity minus the expected
growth rate.
I use the formula and find the price to book value. But at this point in time, all this might look very, utter nonsense, right? The truth is not making sense to you at this point in time. Let me explain this later. Let's first jot down these numbers, okay? What is that? I take the return on
Equity 14%.
that into the dividend payout ratio in decimal format. 0.5435. Okay, I'll tell you what I'm going to do this. Divided by in the denominator, I take a 0.092 the cost of equity, what I got, 9.2%, right?
Yes, sir.
0.092 in decimal format, minus what is the growth rate? 0.06. If I do this, I will get the price to book value ratio of
2.38.
Okay, times.
Yeah.
Is the price to book value ratio. Now, how exactly this formula works, I'll tell you. Okay, guys, let's move on. Just see this what's the screen, what is happening over there. We know that earnings per share into what? Earnings per share divided by book value is what? Return on equity. You all know that. Earnings per share by book value per share is return on equity. We also know that when you do earnings per share into what? The dividend payout and the amount of dividends.
Per share.
Example 11.04. Guys, use a calculator. So it is 11.04 rupees into 54.35%. Give you how much?
6 rupees.
When I do earnings per return on equity into what? Dividend payout. I end up with what? I get the dividend per share by book value per share. When I take the amount of earnings per share into dividend payout, I'll get what? Dividend per share divided by book value per share. Because I know ROE, what is the formula? Earnings by book value, right?
Yes.
Therefore, I get dividend by book value. That is the numerator. Remember, when I do return on equity into what? Dividend payout ratio, I will get dividend per share
by book value per share.
I'll get that. Now you also know this formula, very popular equation. We use cost of equity minus what? Growth rate is the dividend by market price. Or you guys also learn a lot of chapters where they say P naught is equal to D1 divided by KE minus G. It's a very popular equation. I repeat myself. If you want, you can jot down, guys. You would have learned this formula. What is that? P naught is equal to, what is P naught? Market price equals what? Numerator D1 in the denominator KE minus G. Very popular equation. Okay. Few days before the examination, you should be knowing this by heart. Okay.
Yes.
Now just see. We know that cost of equity minus
growth rate
is nothing but dividend by P naught.
Yeah.
By market price per share, right?
Yes, sir.
P naught, nothing but market price per share. So that's why we get P naught is equal to D1 by KE minus G. But here, don't bother about the dividends one. But you should know that from the cost of equity, if I minus the growth rate, I'll get what?
Dividend
I get the dividend yield. Nothing but dividend by market price. I get the dividend yield. That's what dividend by market price. Now, back to this finally. Just see the equation. Numerator, we got what? Dividend by book value.
Book value.
How we got that? I took the return on equity into dividend payout ratio. If I do that, is as good as I get dividend per share by book value per share. Numerator. Look at the denominator. Cost of equity minus growth rate gives you what? Nothing but dividend by
Market price.
When you do this, what happens? Automatically reciprocal will become price to book value.
Book value.
Is that fine?
Yes, sir.
Numerator dividend by book value. Denominator dividend by market price. So reciprocal, no, it becomes price to book value. Got it?
Yes.
So guys, even if you haven't understood this part, no problem. But learn that formula for the examination, okay? But this advice only for people writing in November exam, right? November 24. Not for people writing in. Try to understand this.
Yes.
Now, what is the formula? Go back to that, let's have the printed solution on the screen. So, price to book value ratio equals what? Return on equity into dividend
Payout
ratio, which gives nothing but dividend by book value per share numerator, divided by what? Cost of equity minus growth rate. That gives the dividend by market price denominator. So, you will get your price to book value ratio of 2.38 times. Is that clear?
Yes, sir.
So guys, good luck for examination. Bye-bye.
Thank you, sir.